Hey, it's Max from UNFTR here with the macro take. So we're going to start with our two top stories, which come out of New York and Beijing, but then we're going to do a lap around the markets to highlight a flurry of data releases from the week. High level, the bond market is melting down while the stock market is melting up. And if that doesn't make sense, I got you. Donald Trump went to China with nothing to offer, so it's not surprising that he came back empty-handed. Although he was armed with a keen sense of history, noting how Teddy Roosevelt helped build a university in China. Franklin Roosevelt celebrated China's contributions to winning World War II. And then he offered his own modern-day example of how we cherish our relationship.
Just as many Chinese now love basketball and blue jeans, Chinese restaurants in America today outnumber the 5 largest fast food chains in the United States, all combined. That's a pretty big statement.
Good God, when will it end? Scott Bessent stopped off in Japan before joining the president in China. And listen, I'm no health expert or expert on body language, but is he okay?
We're going to form a board of trade.
My man is sweating a lot. Anyway, we did a piece on inflation earlier this week for Meidas, but then we got some additional news with PPP numbers that came out, so I want to update you on that as well. So we've got import-exports, treasury yields, the summit that wasn't in China, that pinko commie in New York City that's killing the country with his balanced budgets and free childcare and all that. I mean, God, what's the world coming to? All right, so let's start in that communist hellscape that's right next to me, New York City, where Mayor Zohran Mamdani, if that's his real name, is activating Soviets throughout this city. He's forcing people to stand in bread lines, building gulags on every block, and taking private property. Actually, what really happened was Mamdani inherited a $12 billion budget deficit from his predecessor. It was a hole that was dug by mismanagement and wishful accounting under the Eric Adams administration. And in a matter of months, he closed it. He did it without raising property taxes, without gutting services, without the catastrophic cuts that every single pundit said were inevitable. So how did he do it? Politics, partnership, common sense. So first, he went to Albany and got $8 billion in state support over 2 fiscal years from Governor Hochul, who, by the way, had repeatedly signaled that she was not interested in writing the city a blank check. But he got her there anyway because politics and partnership. Then he pushed through a pied-à-terre tax on second homes worth over $5 million. That's what got Ken Griffin so upset and what was in the news a lot. This is for people who park multi-million-dollar apartments in Manhattan as investment assets while claiming primary residence somewhere else. This alone will generate roughly $500 million a year. Then he squeezed out another $68 million out of a reform to the unincorporated business tax credit that had been functioning as a millionaire loophole for years. Now, on the spending side, $1.7 billion in operational savings just from cutting bloat, renegotiating contracts, giving up unused office space, eliminating programs nobody was actually using. He also delayed the class size mandate for 2 years, which was painful and drew criticism, but it brought $500 million in breathing room while he hired 1,000 new teachers to eventually comply with it. So remember Doge? Yeah, this is like Doge. Had it been ethical, moral, and, of course, had it worked. Now, on the investment side, we got universal childcare, $1.2 billion allocated toward it. We got public housing repairs, more fast and free city buses, a pilot program for 5 public grocery stores, libraries and parks funded above his original campaign promises, but there's still a lot to do there. Now, I'm starting here because I think it's important to remind people that good governance is still possible in this country, that you can attract competent people to public service, that establishing priorities around working class issues like childcare and housing and transit isn't some socialist utopian fantasy. It's just budgetary. And he did it within months with a deficit on his back that most people thought was unfixable. Now, not everything is fixed. We've got a long way to go. But I mean, it doesn't have to be all cynicism all the time, because sometimes somebody just comes in and does the job. So remember what that looks like as we go forward. Now, speaking of competence, this was on full display at our mini summit in China this week. Sadly, We weren't the ones displaying it. Donald Trump arrived in Beijing for the first U.S.-China summit on Chinese soil since 2017, and he brought with him a plane full of billionaires. Xi brought something else entirely. Sitting across from our glorious American president in the Great Hall of People, Xi Jinping invoked the Thucydides trap. And now, let's be fair about this. We all looked it up. Don't pretend you didn't. I did. I'd heard of it, but I didn't know what it meant. And you know who else didn't know what it meant? Donald Trump. The Thucydides trap comes from the ancient Greek historian Thucydides, who documented the war between Athens and Sparta. It's one of the earliest and most studied military conflicts in recorded history, and now we're all experts in it. Yay for us. So Thucydides argued that the war was inevitable, not because either side wanted it, but because the rise of Athens as a new power created structural fear in Sparta, the established power, and that fear forced conflict. So Harvard political scientist Graham Allison popularized the term in the early 2010s, applying it exactly to the U.S.-China relationship. And his argument was that when a rising power challenges an established superpower, conflict almost always follows because history tells you it ends in war. So when President Xi looked at Trump in the eye and said, "Can China and the United States overcome the Thucydides trap? Can we create a new paradigm of major country relations and meet global challenges together?" It wasn't a diplomatic pleasantry. That was a major statement. They're going to write about this for years because he's saying in plain language that China is the rising power and we're on the decline. And that the question before us is whether we manage this transition without shooting at each other. I mean, it was the most direct declaration of a global power shift that we've seen probably since the United States did the same thing to Britain and the Allied powers after World War II. And our guy just sat there with his stupid, half-sleepy look on his face because he, like me, didn't get the reference. And of course, that's why you surround yourself with people who are smarter than you, like I do. I married up, and now my kids are smarter than me too. So now let's talk about what actually came out of this summit, because the answer is not a lot. Trade, nothing concrete. Tariffs, no movement. On Taiwan, Xi explicitly warned Trump not to defend Taiwan while we were in the process, literally at the same time, of selling Taiwan more arms. On Iran and the Strait of Hormuz, Xi refused to pressure Tehran, so nothing. The Chinese side didn't even confirm the leaks coming out of the White House about supposed Chinese commitments to buy U.S. oil and agricultural products and Boeing planes. So he came back with a collection of headlines and, we won again, but there's no agreements. So oil crossed above $105 a barrel because the summit produced no breakthrough on the Hormuz standoff, literally the most important thing that's going on in the world right now. Well, the one thing that Donald Trump got right was timing. What a week to get gone, because things on the home front were completely melting down and up, as we said. So let's start with the bond market. The bond market had a week that should have been on the front page everywhere, but it got buried under the summit coverage. So U.S. 10-year Treasury yields broke above 4.5% on Friday, and that is a psychological threshold. So Priya Misra at JP Morgan Asset told Bloomberg that it becomes dangerous not just for the bond market, but for the broader risk complex. So when you cross that number, the market stops asking, is this inflationary? And starts asking, is this stagflationary? And that is a very different question with very different implications. And this wasn't just the US, mind you. There was a global bond sell-off, which is why this really is big news. The 30-year in the UK surged 20 basis points above 5.8%. That's the highest since 1998. Because markets are bracing for a leadership challenge to Keir Starmer, and the UK has a lot of fiscal problems. Japan's 30-year touched 4% for the first time, which reflects growing alarm about Tokyo's financial trajectory. Yields climbed in Germany, Spain, Australia. So the G7 finance chiefs are all sitting around discussing the sell-off and what to do. And the drivers do differ across the countries, but the threat is the same. So, as Barclays put it, inflation resurgence adds to the woes of an already battered bond market. So bonds no longer function as an equity hedge when inflation becomes the dominant risk. Like JP Morgan said flat out that the firm now prefers real estate, instead of bonds as a defensive position. That is a significant statement from one of the largest asset managers on the planet. RBC Capital Markets said if the 10-year hits 5%, Historically, that's the level that compresses equity multiples. This means that the stock market would have to reprice, which brings us to the stock market melt-up. So despite all of this news, the global bond rout, the yield surge, oil above $105, 2 consecutive hot inflation prints, the S&P 500 closed its 7th consecutive week of gains on Friday. So what's going on? Well, like everything else in finance, there's a term for it. It's called a melt-up. And a melt-up is a sharp, momentum-driven surge that runs on conviction and retail enthusiasm rather than fundamentals. And the word that always follows melt-up in every analysis you read is a meltdown. So BCA Research, for one, is projecting a potential 30% further rally to the upside, maybe potentially past the S&P 9,200 mark, all driven by the AI trade before a 2000-style collapse. So they're explicitly comparing this to 1999, and so is Michael Burry of Big Short fame, and believe me, the list goes on. So retail investors are indeed piling into the AI trade. Trading volumes are up 28% since mid-April. That's according to Goldman Sachs trading desk. The Goldman basket of retail favorite stocks has rallied roughly 30% since the start of April alone. Bank of America's Private Client Group now holds a record 65% in equities. Their cash allocation is at 9.8%. That's the lowest on record. So Wall Street is all in. And hey, they almost never get this stuff wrong, except for every 7 to 10 years. So the market is pricing two completely different things at the same time. The bond market is saying inflation is sticky, rates may need to go higher, the Fed is trapped, I don't like it. The stock market, on the other hand, especially tech, says AI productivity gains will ultimately be disinflationary over the next 1 to 3 years, so earnings growth justifies these valuations. And someone will eventually be right. Now, after we put together our earlier Meidas piece on inflation, which I'll link in the description, more data came out that was pretty catastrophic. So I'll give you the quick recap, and then I'll build the PPI story on top of it. CPI, the Consumer Price Index for April, came in at 3.8% year over year. So that's the hottest reading since May of 2023. Remember Biden's disastrous inflation? Now it's his. Month over month, 0.6%. And energy is up almost 18% annually. Gasoline, up 28% year over year. Groceries posted their biggest monthly jump in 4 years. The problem is, real wages fell 0.3% year over year. It's the first annual decline in 3 years, so Americans are working more and earning less in real time. So that's the consumer price picture. Now, layer the PPI on top of it, that's the producer price index, because this was the biggest data news of the week by far. The PPI measures what businesses pay before prices reach consumers. So this is the pipeline. And the pipeline, as of May 13th, is on fuego. PPI came in at 6% year over year. That's the largest annual increase since December of 2022. Now, month over month, it was 1.4%, the largest single month jump since March of 2022. So now core PPI, stripping out food and energy, which I hate, but it is a thing, is still up 4.4% annually. Wholesale gasoline alone jumped 15% in a single month. So just, without food and energy, we're still in an enormously inflationary period. And here's why this matters beyond the number. Producer prices are a leading indicator of consumer prices. So when businesses are paying dramatically more for inputs, they pass it on downstream. So it means that more than likely, we're not even at the peak of the inflation cycle. We might be in the middle of it. And that's a oh boy moment. Now, the import-export data this week added another layer to the inflation story that I don't think gets enough attention. Overall import prices rose 1.9% in April, 4.2% over the past year. So everything coming into the country. But strip out the fuel component, you still get 0.8% in a single month and 2.9% annually. So this is broad-based. It's not just oil and gas. Now, fuel imports are the headline. Petroleum and petroleum products are up 19% in April and 22% over 12 months. But look at what else is coming in hotter. Finished metals, up 7% in a month. Capital goods, including computers and semiconductors, machinery, 1.1% in a month. Food and beverage, 0.9%. So this is tariff hangover components and new supply chain problems coming to fruition. Now, here's the trade data point that gets almost no coverage because we are so blindly ethnocentric in America. Export prices are running even hotter than import prices. U.S. export prices rose 3.3% in April and 8.8% over the year. Non-agricultural industrial supplies like petroleum, chemicals, and all that were up 7.3% in a single month. Export air freight up 8.5% in April. So what this tells you is that the rest of the world is also paying more for what they buy from us, which is a dollar strength play in the short run, but a competitiveness problem in the medium term. And we are indeed exporting our inflation around the world. And when you look at the data by country of origin, imports from Canada jumped 5.6% in April alone. That's a direct tariff artifact, right? North American supply chains are also just as screwed. So we're exporting inflation and importing it simultaneously. Again, oh boy. Now, sorry to pile on, but jobless claims this week came in at 211,000 ending May 9th. And on the surface, that looks like pretty much every other jobless claims report. So the 4-week average is sitting around 204,000. These are not recession numbers by historical standards, but the story is below the headline as usual. Initial claims ticked back up 12,000 from the prior week, and continuing claims, which is people who filed last week and are still collecting, rose to 1.78 million. More importantly, look at the trend over the past year. A year ago, initial claims were running at 226,000 and continuing claims were at 1.8 million. So we're down year over year on both measures, which the administration will tout as evidence of a strong labor market. What that framing leaves out, of course, is what's happening to the people who have exhausted their benefits and dropped out of the labor force. No extended benefit programs are currently triggered in any state, meaning the federal safety net extension isn't activating because the headline unemployment rate hasn't crossed the statutory thresholds. But the people whose benefits ran out aren't showing up as unemployed. They're showing up as out of the labor force. That's a different count. It's a much darker count, too. And then there's the wage picture. I mentioned that real wages fell 0.3% year over year. Now, for the bottom half of the income distribution, the workers most exposed to inflation in food and energy and shelter, that number is way worse. Wage gains in that cohort are now way below the inflation rate, which means any nominal increase in pay is being wiped out at the grocery store and the gas pump. The tax refund stimulus that was supposed to give households some sort of cushion earlier this year, or I think just saved us all, it's gone, right? Consumed by a cost of living that's accelerating faster than income. The average American household isn't treading water right now. They're going into debt to stay in place. And into this environment, the inflation, the melt-ups, the meltdowns, the supply chain snarls, and the gas prices. This week, the Senate confirmed Kevin Warsh as the new Fed chair. Now, I've covered Warsh pretty extensively on UNFTR, so I'll keep this tight. Warsh is a former Fed governor, Wall Street Republican, longtime critic of the Fed, and a pretty smart dude. He's also the son-in-law of a billionaire donor to Donald Trump named Ronald Lauder of Estee Lauder fame, and himself is so personally wealthy that of his $250 million or so in assets, he refused to disclose $100 million of it, leading the Democrats on the committee to ask whether any of these investments were A, tied to Trump, B, foreign adversaries, or C, tied to Jeffrey Epstein since Kevin Warsh was an associate of his. And guess what? He didn't say. So there's that. He's also been handed what might be the most impossible job in American history, considering his boss wants him to cut rates in an environment that does not call for that and on a committee that's not going to let him. I mean, certainly not in a 6% PPI environment. It's just not going to happen. Moreover, the composition of the board is now less favorable to this view because Stephen Myron, Trump's rate cut lackey, has to leave to make way for Kevin Warsh because Jerome Powell is staying on the committee. But here's the deeper problem. And this is where I would encourage you to check out a piece that we did on UNFTR as well. I'm sorry to keep hawking it, but I did something called the 10 economic terms that you need to know right now. And one of them is fiscal dominance. Now, fiscal dominance is a condition where the government's debt burden is so big that monetary policy loses its independence. It just doesn't have the same bite or effect because the Treasury is running trillion-dollar deficits and has to roll over trillions in debt every single year. The Fed has less ability to constrain rates, not by law, but by arithmetic. You raise rates too high and you blow out the federal budget. The interest payments become the budget. So at some point, the Fed isn't setting monetary policy anymore. The bond market is. And this bond market just told you very loudly where it thinks we are. Now, Warsh doesn't control any of the structural variables that got us here. He can't fix the deficit. That's a fiscal issue. He can't lower oil prices. That's a dummy issue. He can't reverse the supply chain disruptions that are baked into the import-export data, and he can't undo the tariff architecture, also a dummy issue, that's running through the PPI. Now, he can raise rates into a slowing economy and risk a hard landing, or he can hold rates and just watch inflation run. That's not much of a policy choice, though. It's a trap. It's not a Thucydides trap, of course. It's just a trap. So, welcome to the job, Kev. And so that's your macro take for the week. Bond market's melting down. The stock market is melting up. A diplomatic trip that produced nothing but maybe a vocabulary lesson and a little bit of Greek history. A mayor in New York City proving that good governance is still possible. And a new Fed chair walking into the hardest job in that building. My name is Max from UNFTR. Sources for everything that we covered are in the description below. Make sure to like the video and sub to the Meidas Touch and leave me a comment if there's something that you'd like to see me cover. You can find me on YouTube and Blue Sky at UNFTR. And don't forget, you can sign up for our free weekly newsletter at UNFTR.com. Thanks to the Meidas Mighty for having me here, and I'll catch you online.
Want to stay plugged in? Become a subscriber to our Substack at MeidasPlus.com. You'll get daily recaps from Ron Filipkowski, ad-free episodes of our podcast, and more exclusive content only available at MeidasPlus.com.